Welcome to the deep dive. We're seeing some truly remarkable things in the markets right now.
Absolutely.
Just a few months back, April, there was this real sense of fear everywhere, people wondering if things were about to fall apart.
That's right. The sentiment was pretty bleak.
And yet here we are. It almost feels unreal. Bitcoin, gold, the NASDAQ, the S&P 500, they're not just up, they're hitting new all-time highs.
Yeah.
It's this complete turnaround, almost whiplash, that I think caught a lot of people off guard. The market bears, well, they're having a really tough time, let's just say.
You certainly are.
So what's really going on here, what's driving this unprecedented surge? That's what this deep dive is all about, trying to unlock these underlying forces. We're talking rapid tech acceleration, shifts in societal values, monetary policy stuff.
A lot of moving parts.
Exactly. And we want to help you understand what all this volatility, this uncertainty, this chaos really means for you, for your world, and yeah, for your portfolio too. We're digging into some really fascinating insights. From a conversation with Jordi Visser, he's a 30-year Wall Street expert featured on Anthony Pompliano's channel. We'll unpack what he calls his prophecy and this current scramble in the financial market. So let's jump right in.
It really is an astonishing reversal, isn't it? The speed of this rally. I mean, it's genuinely surprised even, people who've been watching markets for decades.
Right.
You're spot on. The bearish feeling just a little while ago was palpable. Everyone felt like, okay, here comes the downturn. And look, while maybe a lot of individual investors haven't fully capitulated, they haven't completely flipped bullish yet.
Still nervous, maybe?
Exactly. Still cautious. But the pressure on the professional money managers, it's huge. You're the big institutions, right? Managing tons of money. And they have these strict performance benchmarks. They just cannot afford to lag behind the market or their peers.
Career risk is real.
Absolutely. So when the market rips higher like this, they're basically forced to jump in. It creates this kind of scramble, like you said, this frantic rush to figure out what's driving it, catch up, get positioned correctly. It's a really interesting dynamic.
That pressure, that scramble.
Yeah.
It's clearly a big factor.
Right.
Okay, so let's unpack it. What has been the main catalyst here? What's the theme that just keeps coming up? Because it feels like more than just a temporary bounce.
You nailed it. The undeniable driver, the sort of central theme powering all of this, it's artificial intelligence, AI. That's the engine.
Okay, AI.
But here's the tough part for investors right now. They're having a really hard time figuring out, okay, are we buying AI at the absolute peak? Have we missed the boat?
Right, fear of heights.
Exactly. We've seen these incredible, almost vertical moves in certain stocks. Take Palantir Data Analytics, AI focus. It's just gone through the roof.
Yeah.
NVIDIA, obviously, the chip maker, basically building the AI infrastructure back at new all-time highs. And then look at Micron. Memory chips, we talked about it when it was, in the 70s? Maybe even the 60s.
I remember that.
It just hit close to 130 this week. So buying into moves like that so fast, so steep, it's tough. It feels like chasing, It goes against the grain for a lot of people. A high-stakes game.
Okay, so if those obvious AI leaders are already flying so high, that raises a really interesting question. What's the market doing now? Is it just giving up on AI? Or finding new angles?
Exactly right. They're pivoting, adapting. Instead of just, piling more money into the NVIDIAs and Microns that have already surged, the market's now actively hunting for the laggards.
The laggards, okay.
Yeah, companies that haven't really joined the party yet but might still benefit somehow, or maybe they just look cheap now. Nike is a perfect example of this playing out.
Nike. How does Nike fit in?
Well, it had been down for a while, right? Hit by tariffs, inventory problems, stuff like that, and now, boom, it's up like 15% pretty quickly. But it feels more like a relief rally for Nike, Okay, things aren't as bad as feared. It's not really seen as a direct AI play.
Right, not like NVIDIA.
Exactly. So it suggests the market's search is broadening out, looking beyond the immediate, obvious AI winners for other kinds of value or opportunity. It's like investors are saying, okay, we get the AI wave, but where else can we put money to work now? It shows the theme is maturing a bit, maybe moving past just pure speculation.
So this sounds like it's much bigger than just a short-term market trend then. It feels more fundamental, more long-lasting. You brought up this idea of acceleration, that this isn't just a blip, but the defining theme for the next decade. What does acceleration really mean here beyond just stock prices moving fast?
It's a huge concept, really profound. Acceleration isn't just about prices rocketing up, though that's part of it. It's happening everywhere, across society, across markets, faster than ever before. I mean, think about price acceleration first. We just talked about Micron doubling, right? Or look at the long-term picture for the Magi 7 stocks. Apple, Microsoft, Google, Amazon, Nvidia, Tesla, Meta. Their growth over the last 10, 15 years hasn't just been linear. It's been accelerating, growing faster and faster compared to big companies of the past.
Exponentially, almost.
Almost, yeah. But it's not just prices. There's information acceleration, too. The speed at which we get information now, it's dizzying.
Oh, absolutely.
News hits, market reacts in milliseconds thanks to algorithms. People react on social media instantly. It creates this feedback loop, this hyper reaction leading to these wild swings. The key isn't just that info is fast, but that our reaction time to it has shrunk, changing how markets behave.
Makes sense.
And then there's emotional acceleration right in the market. People get very fearful or very greedy almost overnight, don't they?
Yeah, the sentiment swings are crazy.
Yeah. And those emotions spread like wildfire through social media, news, driving incredible volatility, human emotion, but on fast forward, playing out in prices. So for you, the listener, the big question becomes, okay, am I built for this volatility? Do I try to ride these waves, or do I look for calmer waters? Your whole investment approach might need rethinking in this faster world.
That's a critical point. So acceleration everywhere, but you mentioned this is happening against a confusing economic backdrop. Tell us about the LEI, the leading economic index. How does that fit in?
Right, this is where it gets really interesting and frankly contradictory. The LEI, think of it as the economy's forward-looking report card. It bundles 10 key indicators, manufacturing orders, housing starts, jobless claims, things like that, to predict where the economy is headed.
It's usually pretty reliable.
Historically, incredibly reliable, very powerful predictor. Now, get this. The LEI has been negative between -1% and -7% every single month since August of 2022.
Wow, that's a long streak.
It is. And here's the kicker. Since they started tracking this index, it has never been below -1% without a recession following. Never. Zero false signals on that front.
It's dark.
It is. And the components screaming recession right now. 2 related to jobs, 3 related to new orders, housing permits, consumer sentiment, the inverted yield curve, all pointing down. These aren't just numbers. They reflect slower hiring, less business investment, people feeling less confident, basic building blocks of a downturn.
Okay, so the LEI screams recession based on history. But then we look at the stock market, hitting all-time highs. That's a massive disconnect.
Yeah.
How do we square that circle? What's going on with the S&P 500?
That disconnect is the story right now. The S&P 500 particularly is where the AI story is happening, and it's being driven by a surprisingly small number of companies.
The MBCS 7 again.
Primarily, yes.
Yeah.
The Magnificent Seven. They account for something like 55% of the entire S&P 500's earnings growth. 55%.
Even though they're only about 30% of the index's value.
Exactly. So if you're bearish on the market today, you're essentially betting against this AI-driven acceleration side of growth. You're betting against Nvidia, Microsoft, Google, and the rest. It's almost a binary bet. Either this AI growth continues and maybe broadens out, or the traditional economic indicators eventually win and pull everything down. It's this strange split market we're in.
Fascinating. So moving beyond the market itself,
Yeah.
what does this all mean for us, for the future? How is AI evolving past just being a trade and actually, fundamentally reshaping things?
We're really at an inflection point, a major shift. Think back just 2.5 years ago when ChatGPT launched. Back then, AI felt mostly like memorization, right?
Yeah, like a super smart search engine.
Exactly. A chatbot recalling information like a librarian fetching facts instantly. Impressive, yes, but still basically processing stuff that already exists. Now we're moving rapidly into what's called the agentic side. This is the real leap. We're shifting from AI that just finds and sorts information to essentially digital employees that are doing thinking through reasoning and inference.
Digital employees. Okay, unpack that. Maybe an analogy.
Okay, think about that super librarian again. They can find any fact, summarize any book instantly. That's memorization. Now imagine that librarian can also analyze massive data sets, develop strategies based on that analysis, spot complex patterns, and even make independent decisions to achieve a goal, like a seasoned executive.
Okay. So it's not just recalling, it's acting and reasoning.
Precisely. It's becoming a cognitive partner, able to handle complex, goal-driven tasks without needing constant human direction. That's the jump.
Wow. And the implications are huge then.
Massive. We're already hearing CEOs, not just tech CEOs, but leaders in manufacturing, finance, retail, saying things like they may never need to hire again for certain roles. Yes. Now, it's not necessarily about mass layoffs of current staff, more about a drastic cutback in future hiring. They're saying, going forward, the new hires, they're going to be digital employees.
That's a big statement.
It is. And then you layer on the humanoid factor. We're expecting that to become more and more evident by the end of the year. Companies like Figure AI are making real progress, building human-like robots powered by advanced AI.
Like actual robots walking around.
Potentially, yes. And this is creating what some call a very sexy investment environment. It broadens things way beyond just, say, OpenAI or NVIDIA. You start looking at analog chips, specialized robotics parts, the whole ecosystem powering these intelligent machines.
That's a truly mind-bending future unfolding. Digital employees, humanoids. So for listeners trying to wrap their heads around this and maybe invest, where do they look? Especially if some key players are private.
Great question. It's definitely tricky when so much cutting-edge stuff is happening in private companies. First off, I'd say follow the experts who live and breathe this stuff, like Chris Camillo. He's been deep in this space for ages and genuinely thinks it's the biggest theme of our lifetime.
And he's not alone, right? Musk and Andreessen.
Exactly. When you hear Elon Musk talking about more humanoids than people by 2035 or 2040, or Mark Andreessen calling it the biggest industry ever, you have to pay attention. Something huge is underway.
So where can public market investors get exposure? Tesla, maybe.
Tesla is one angle, yeah, because they're not just cars anymore. They have Optimus, their humanoid robot project. But focusing on the AI brains, the thinking and reasoning part, you have to look at the bottlenecks. And a huge one is memory.
Memory chips again.
Absolutely. High bandwidth memory, specialized DRAM. AI models need tons of it to learn, process, and remember without hallucinating or making stuff up. That's where public companies like Micron, SK Hynix, maybe Samsung come in. They're making the crucial components.
Okay, memory is key. What's the next bottleneck?
Power, energy, it's already becoming a massive issue.
Powering all this AI.
Exactly. Running these huge AI models, these digital employees, these future humanoids, it takes an incredible amount of electricity, almost unimaginable amounts. And this is where, surprisingly perhaps, companies like Exxon and Chevron come into the picture.
Oil and gas companies. Really?
Believe it or not, yes. They act as a crucial bridge right now. They have the scale, the balance sheets, the existing infrastructure, especially natural gas plants, to provide the massive power needed until nuclear energy can potentially scale up longer term.
Huh. Never thought of it that way.
They're already talking to the hyperscalers, the big cloud providers running the AI models. These hyperscalers are confirming this exponential energy demand driven by token usage. Every time an AI answers a query, makes an inference, thinks. It uses tokens, and each token costs energy. So yeah, even traditional energy companies are becoming key players in the AI infrastructure build-out.
Fascinating link. Okay, bringing it back to today. How are established companies using AI right now for efficiency? You mentioned Salesforce.
Yeah, Salesforce is a great example. They're really pushing AI agents in their customer relationship management, their CRM systems. They've talked about how clients like Disney are using it for smarter booking systems, more efficient call centers. Basically having AI handle routine interactions.
Freeing up humans for harder problems.
Exactly. But what's really eye-opening is what Salesforce is doing internally. Mark Benioff, the CEO, said recently that something like 30 to 50% of their own internal work is now being done using AI.
30 to 50%, wow.
Yeah. Think coding assistance, data analysis, admin tasks. It's not just customer-facing. It's about radically boosting internal efficiency.
And that flows right to the bottom line.
Absolutely. It's all about efficiencies and boosting profit margins. Labor is a massive cost, right? Wages are like half of personal income in the U.S. So if AI can reduce labor needs or make existing workers way more productive, that's pure profit gain.
We're seeing this elsewhere too, right? Walmart, Nike.
Definitely. Walmart's using AI heavily for inventory management, optimizing supply chains, reducing waste that gets them a higher valuation. Nike mentioned inventory management on their earnings call too. Any company with the tech talent and the money is focused on this.
But the impact isn't the same for everyone, is it? How does it differ?
No, it varies hugely. Smaller tech companies, especially those heavy on coders or admin roles, They're likely facing actual firings because AI can replace those jobs pretty directly and cheaply.
Okay.
For bigger, established companies, it's often more about less hiring. They might have staffed up a lot recently, so now they just stop adding people. Kind of a silent layoff through attrition.
Right.
But the game changer is for startups. You can now potentially build a company to, say, 5 million ARR, annual recurring revenue, with almost no people, maybe even a billion-dollar company with very small amounts of people, driven purely by AI and tech. That completely changes the economics of starting and scaling a business.
That's incredible. But what about the rest of the market, the S&P 493s you called them?
That's the flip side, and it's concerning. The S&P 493, basically the S&P 500 minus those top MEG7 names, many of them just aren't keeping up. Their revenue growth is maybe around nominal GDP, like 4.7% to 5%. Meanwhile, the NG7 are growing double digits, sometimes more.
The gap is widening.
Hugely. Historically, the S&P 500 grew revenues faster than the economy, maybe 1.5 times nominal GDP. That multiplier effect seems gone for the 493. So if these companies have debt and they can't grow revenues much faster than the overall economy, many could gradually go out of business. They just can't compete with the speed and efficiency of the AI-driven startups or the scale of the MEG7. It's creating this real split, a bifurcation in the market.
That's a pretty stark picture. Fast-moving AI winners and struggling traditional players. But what happens when this AI adoption hits people's jobs directly and causes, real anger and pushback? We're talking livelihoods here.
That's exactly where the friction happens, and we're already seeing it. The Mr. Beast thing is a perfect recent example.
YouTuber. What happened?
He released an AI tool to create video thumbnails. You type in what you want, maybe upload a logo, say make this change, and bam, instant professional thumbnail. Amazing tech, right? Democratizes design.
Sounds useful.
But he got massive backlash online from the YouTube community, from graphic artists, thumbnail creators, people whose jobs felt directly threatened. And what did he do? He capitulated. Pulled the AI product, replaced it with a marketplace for human designers. Now, while maybe well-intentioned, that's kind of like blocking progress.
How so?
You can't let the future be held hostage by people unwilling to adapt to new tools. It's like telling a farmer, sorry, no tractor for you because my horse will be out of work.
Right. The Luddite argument.
Exactly. Innovation ultimately makes everything better by giving more people access. Now anyone can get a decent thumbnail, not just those who can afford an expensive artist. It expands creativity, even if it changes where the labor is needed.
So you think we'll see more of this resistance?
Oh, absolutely, and probably much more intense. I fully expect we'll see taxi drivers getting out of their cars, beating the cars, when Waymo and other robotaxis really hit cities like New York.
You think it'll get violent?
Potentially.
Yeah.
Think about the difference between Waymo in, say, Austin versus dense unionized Manhattan. The pushback will be fierce. But here's the hard truth. The self-driving car will win. It may lose the battle, but it'll win the war. The tech is just too efficient, too powerful in the long run.
The speed is the issue, maybe.
The speed is unprecedented. AI is moving way faster than previous shifts, like smartphone apps. Back then, you had maybe a few years head start. Now, ideas get copied instantly. Governments won't be able to move fast enough to regulate it or deal with the social fallout. And honestly, I'm not sure human beings are going to be able to handle this pace emotionally or economically.
Leading to more anger.
It's bound to cause a lot of people angry as they see the wealthy doing well and everyone else having a harder time. Yes, there's a weird shortage of jobs right now in low-wage sectors like daycare or fast food. But those jobs often don't pay enough to live on in expensive areas, so you have this volatile mix. Rapid tech progress, job displacement, and economic hardship all swirling together.
This feels like a perfect transition to the monetary policy side. How does the Fed, interest rates, government action, how does that overlay onto all this tech and social change? We've seen money supply grow, Bitcoiners get excited, but now there's this huge pressure on the Fed to cut rates. That seems significant.
It's hugely significant, and this government pressure is an important story that is not really being talked about nearly as much as it should be.
Why not?
Well, think about it. Donald Trump, even out of office, is constantly bashing Powell, demanding rate cuts. His allies, his staff names like Lutnick, J.D. Vance, Bessent, they're echoing it, almost acting like a Shabbat Fed. There's even talk about naming a new Fed chair in September before the election.
That sounds like direct political interference.
It is. It's a blatant disregard for the idea of Fed independence, which has been a cornerstone belief of the financial system for decades. That independence is breaking down, eroding right before our eyes. That's a fundamental shift.
But are there actual economic reasons why the Fed might cut? aside from the politics.
Oh, definitely. And those arguments align with the pressure, conveniently. You've got, as we discussed, only a few companies benefiting significantly, the G7, some startups, while the majority of people in the country are not doing well.
It's a two-track economy.
Exactly. The job market, despite the headline unemployment rate, looks soft underneath. Year-over-year payroll growth is down to 1.08%. That historically signals recession ahead. We had negative GDP in Q1 and Q2 combined look like sub 2% real growth. And inflation has come down enough to give them cover the chance to cut rates.
So cutting rates would help who?
Well, it addresses the affordability side. Makes mortgages, car loans cheaper. It might slightly ease the job situation competing with AI by stimulating broader demand. And it helps college graduates struggling to find good jobs and move up. All of this feeds into that growing mistrust and really anger towards all incumbent officials.
So it's politically useful, too.
Absolutely. Cutting rates is a way to potentially ease public discontent. And crucially, it helps manage the massive national debt problem. Lower short-term rates make servicing that debt much cheaper for the government.
Okay, so we have economic pressure, political pressure. How does this tie into bigger societal shifts, like the rise of socialist ideas, especially among younger people? You mentioned Mamdani in New York as an example.
Right. Mamdani is a really vivid illustration of this shift playing out politically. His platform, based on the source, is openly socialist. He says capitalism is not the best system. He's called for defunding of the police, wants to increase taxes on wealthier, whiter neighborhoods and redistribute that.
Ideas that seemed fringe not long ago.
Exactly. 10 years ago, that platform would have been seen as absolutely crazy for a major NYC candidate. Now, it's resonating. It has real traction.
Why the appeal now?
Because, as we've discussed, a large chunk of the younger demographic feels their situation is not good. They see the system is broken and are looking for radical solutions. Now, the expert in the source warns that simply offering free stuff and redistribution while appealing doesn't work long-term for broad prosperity.
Right.
But the key question for markets, for investors, is what happens if a very big portion of this younger generation enters the workforce, becomes voters, maybe even leaders, with this socialist mindset? Does that change everything? Investment strategies, capital flows, the definition of capitalism itself. It's a profound demographic and ideological shift to watch.
Let's dig into that why, though. Why do younger people feel this system is so broken? It's not just politics. It's their lived economic reality. Right?
Absolutely. It goes deep. Think about Joseph Schumpeter, the economist known for creative destruction. Capitalism constantly destroying old structures and creating new ones through innovation.
Yeah.
Schumpeter actually worried that if innovation accelerates too fast, it could cause capitalism to be broken, especially if inequality gets extreme, if a few people had most of the money. That sounds a lot like today, doesn't it? The reason these political shifts are happening, particularly among the young, is they don't believe the system will ever come back to what their parents had. They feel it's only gotten worse each year of their lives.
What's their experience been like?
Well, think about someone 25 years or younger. They grew up with the internet exploding, then Amazon dominating, then smartphones everywhere. This constant accelerating tech has led, from their perspective, to less jobs, very few companies that are doing well. It's why efficient chains like Chipotle replace the old local diner tech, optimizing, but sometimes displacing.
And the dream is gone.
That's the core of it. They can't live the dream that they thought was supposed to be there. You know, the standard path. Get a decent job, climb the ladder, earn more, start a family, buy a house. That entire path is gone for many.
What does that look like practically?
It looks like graduating with huge student debt, maybe taking unpaid internships, finding entry-level jobs demand years of experience you don't have. It means gig work with no security. It means housing is unaffordable, so you're renting forever or living with parents. They start adulthood deep in debt, face job uncertainty, and can't buy a house. Peter Thiel pointed this out, why students are so angry, why socialism is happening. Their economic starting point and trajectory are just fundamentally different, breeding disillusionment.
Which brings us finally to Bitcoin. If the old path is broken, the system feels rigged. How does Bitcoin fit into all this? Accelerating AI, job disruptions, social unrest, changing worldviews. Where does it sit?
Bitcoin, for me, represents the system that eventually is built through the disruption of all businesses. And I'll say it again. Bitcoin, for me, is the S&P 500 eventually.
The S&P 500. Wow.
Yeah.
Can you give us a metaphor for that?
Okay, imagine the traditional financial system, fiat currencies, old assets, is like a big old ship. sailing through incredibly stormy, fast-changing waters. It's being battered by the waves of AI, rocked by government money printing storms. Its very structure, like Fed independence, is cracking. Bitcoin is emerging as a new kind of vessel, a digital, decentralized lifeboat.
A lifeboat.
Yeah, an unsinkable lifeboat built for this new environment, especially appealing to a generation that sees the old ship breaking apart. It offers scarcity, censorship resistance, a hedge against the very instability eroding the old system. It's designed to thrive where the old system fails.
And in this future Bitcoin world.
It could be a world of abundance, potentially. AI drives productivity so high that prices of everything have gone down. Maybe you don't actually need the money in the same way. Identity shifts away from just your job. You need to be entrepreneurial, adaptable, constantly learning, creative. The stable, lifelong career path? Gone. Younger people, used to remote work, digital life, might actually be better equipped for this fluidity.
And the link to socialism.
Well, I think socialism is just the next point of the capitalism side. The angrier people get, the more left behind they feel, the more money governments print trying to fix it. Hence, transfer payments are going up. This constant debasement, this attempt to paper over the cracks, it just fuels the case for something like Bitcoin. That's why I believe Bitcoin will not stop going higher. It will replace a lot of the fiat assets over time. It feels like an inevitable response to these converging breakdowns.
That's a bold vision, Bitcoin as the lifeboat, the eventual S&P 500. Now, one last fascinating point. For ages, people thought Bitcoin's rise meant gold's demise, that Bitcoin would demonetize gold in a zero-sum game.
Right, that was the common narrative.
But weirdly, Bitcoin has been successful and gold has gotten bigger recently, both hitting highs. So is the pie expanding? Is it not zero-sum after all?
It certainly appears that way on the surface, doesn't it? But I think there's something happening under the hood that tells a different story. It's not just a bigger pie for everyone.
What's happening under the hood?
Think about why gold is doing well. It's largely because other massive traditional stores of value are not doing well. Global wealth is huge, maybe $500 trillion. Stocks and bonds are half of it. But look at real estate, another massive chunk. Prices are not rocketing like they were. We just saw negative month-over-month house prices, rare outside recessions. China's property market is going down significantly.
Okay.
Bonds, we're in a bond bear market. They've done nothing since 2019. So gold is rallying partly because these other huge asset classes, real estate and bonds, are struggling. Capital has to go somewhere.
So it's a rotation, not just expansion.
Exactly. And the biggest argument for Bitcoin here is the transfer of wealth. Think about today's billionaires, mostly older in their 60s, 80s. What do they own? Gold, real estate, traditional assets. The majority of them don't own Bitcoin.
Right.
But as that wealth transfers to younger generations over the coming decades, their worldview is different. They grew up digital. Their preferred store of value is much more likely to be Bitcoin. That generational shift is huge for Bitcoin long term.
And the political backdrop helps Bitcoin too.
Absolutely. What Donald Trump is doing, challenging Fed independence, maybe not caring about the reserve currency status, these things directly undermine trust in the traditional system. The dollar weakening because foundational beliefs are breaking down. That benefits non-sovereign assets like gold and Bitcoin.
So it all comes together.
It really does. Bitcoin benefits from the unrest that is seemingly happening at a faster pace, job shifts from AI and humanoids, governments undermining their own institutions like the Fed, questioning the reserve currency. All of these things are breaking down right now. And in that breakdown, Bitcoin's core properties, decentralized, scarce, programmable value, look increasingly attractive as a new foundation.
Wow. What an incredible deep dive this has been. We've covered so much this surprising rally fueled by AI acceleration, the massive impact on jobs and the economy, the societal pressures, the monetary shifts, and how Bitcoin fits into this picture as this critical emerging asset. It really feels like a moment of profound change.
It really does. A lot to process.
So here's a final thought for everyone listening. As we stand here, looking at a future potentially reshaped by digital employees and humanoids, where the whole idea of a job is changing incredibly fast, what does finding purpose and economic security even mean anymore? How will you navigate, adapt, and maybe even thrive in this accelerating future?
That's the question everyone needs to grapple with.
It is indeed. We're going to all sit and watch it play out together. If you found this deep dive valuable, maybe a little mind-bending, please do follow, like, and share the show. It really helps. And to stay plugged into these topics, you can follow What Bitcoin Taught Me on all the socials, Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn.